What's up, everyone? I'm over here with my man Cody again for the last video we did. If you guys missed the video that Cody and I talked about how to buy your first house, your investment property, your first investment property, go watch the video. We had a lot of great information on there. But today we want to do part 2 for you guys, okay? I hear this thing about house hacking. You buy a property, rent the basement out, or rent a room out, but rates so high, do you think it's actually better to stay renting, wait till the rates go down, and then go buy a house hack?
You bet. Well, I love the idea of a house hack, no doubt about it, right? Because if you're renting right now, if you're paying 100% of your rent, but then you could go buy a house, the payment might be a little higher because the rents are a little bit, or the interest rates are a little higher. But if you can rent out the basement or a couple rooms in the other house, you could probably get your mortgage payment minus your rents to be actually below what you were paying for a rental right now.
And at least you own the property.
Exactly. Right? Well, and that's the thing. We think as rates come down, you're gonna see home prices really come up as well, right? So home prices stagnated a little bit last year. In the face of 7% interest rates, we've seen a significant increase in home prices. Imagine what's gonna happen to home prices when rates go down to 6 or 5 or maybe even below.
And imagine how many more buyers gonna actually come off the bleacher, you know, frantically running on the field trying to buy. I mean, I just listed 7 new construction last week, 4 resale home, and all 4 of the resale home was listed anywhere between 600 and 750, and all 4 of them sold within literally less than 5 days.
Yes.
As much as people complain about 7%, I mean, people are buying out there.
That's right. Well, we're light on inventory. There's not a lot of homes available for sale. That's a national issue, right? Very constricted in the Northwest as well. And when you see those rates come down, that means even more people are out buying houses. We know some numbers. For every 1% that interest rates go down from today's market, another 1 million people will be able to afford to buy a home. Another 1 million competitors for you out there shopping to buy a house. Whether it's your new primary, another rental property, whatever it is, there's gonna be more people that want to buy when rates come down. I think you should buy now and plan to refinance later.
Why would you want to compete against 1 million other buyers when you can do it without competing? And then you can always refinance it later.
Yes, exactly. Well, that's the thing too. If you don't buy today and you wait for rates to get better, then you rob yourself of the ability to refinance. That's right. So now you've paid more money for the same house you could have gotten before, and you get that better rate, yes, but here's the math, right? If let's say rates go down 2%. But the property goes up 20%, right? The payment's the same. It's a level payment, right? So you buy a house today for $500,000. It goes up from 500 to 550, 550 to around 605, 610, right? If that rate goes from 7% today down to 5% 2 years from now, the payment is literally the same. But if you bought it at $500,000, now you've got $110,000 in equity 2 years later, and you've got the ability to drop your payment by about $500 per month in that scenario. So you kill your ability to refinance by waiting for lower rates.
And by waiting, you don't even get the equity.
Correct.
If you actually start now, and I know from all the news I'm hearing that sometime in 2024, they're talking about the new 10-year cycle is running again. It's running up again. So if you wait until the rates go down a year and a half from now, let's say, for example, you're losing out on a year and a half of appreciation.
That's right.
Right? So bottom line, folks, here's the thing. House hack, if you got good income, you got good credit, go and buy a house with less competition, get a house hack deal. Live upstairs, rent the basement, or rent a bedroom, right? Get a duplex, triplex, fourplex, rent out the other unit. Those units and bedroom, you can offset your mortgage. You can actually stay for less than renting, but at least you're gaining the equity. And you can refinance later.
That's right.
We got a lot of people here that are watching us that are either home buyer, or they are actually investor buying turnkey property, or they're investor buying fix and flip, fix and hold like a burr, or build new construction. There's a bunch of different type of loan out there. Traditional loan, new construction loan, hard money lending loan. Let's break down the difference.
You bet.
Let's talk about traditional lending.
Okay.
What's the difference?
So for traditional lending, you're going to need a good collateral, right? You're going to need an asset. The house has got to be in decent shape, right? It has to pass appraisal. Traditional lending requires good credit, decent credit, right? You've got to have verifiable income. You've got to have add money for down payment, right? Those are the key things about getting conventional financing or traditional financing. That gives you the best price, right? The best price and the best terms. So if you've got all those things, and that's the kind of house you're gonna buy, you can get a conventional loan and get the best possible rate, the best possible terms.
And it doesn't matter if you actually live in the house or you actually buy in to rent out, conventional loan.
Yeah, so you can get a conventional loan for either of those. It does require a bit more down payment for a investment property than it would for an owner-occupied property.
Yeah, owner-occupied, if you're a first-time home buyer, a little 3.5%. As an investment property, 25% down, okay? What's the rate on like a traditional 3.5% down?
Yeah, so 3.5% down would be an FHA loan. Conventional would be either 3 or 5% down. In today's market, you're probably in the like 6.5 to 7.25% range, somewhere in that ballpark.
Well, and then investment property?
Investment property, if you're gonna pay some points with that where you maybe wouldn't pay with an owner-occupied property, so you're gonna be probably 6.75 to maybe up to 8%.
Okay, that's a traditional home that's already clean, turnkey, no work order, ready to go.
Correct.
All right, now let's talk about hard money lending. Right, we hear that people use that a lot. Right, let's break down hard money lending. What does that mean?
Right, so hard money lenders are not gonna lend on owner-occupied property. So they're not gonna do that. So just for investment properties.
There you go.
And for investment properties, they're a spectacular loan when the property needs some love, right? If it's in bad shape, it needs some updating, it just maybe wouldn't pass an appraisal, right?
And traditional bank won't do it because it's too much work order on.
That's correct, yeah, exactly. And maybe you're also not gonna get the value that is there because you have got a great deal on it because it's in rough shape, but it won't be worth what you think it's going to be worth until that work's been completed. So the hard money guys, they look forward, right? They'll appraise the project as if you've already done that work, and they'll give you a bucket of money to be able to go out and do that work.
To buy the house and to give you money to rehab the property.
That's right, all together. Now, you'll pay a higher price for that, right? The more expensive, you'll have some points, you'll have some fees, and you'll pay, I would imagine, somewhere between 10 and 13%, depending on your experience level.
That's right, and they want 20% down of the combined your purchase and your rehab. So let's say you purchase this $450 and you got $100,000 in rehab, so even for $550, they want 20% down of that, okay?
There you go. But then they'll allow you to get in and do that work. They'll do draws, and then as you get work done, you can pay your contractor. And then when you're all said and done, if you're gonna turn around and sell it, cool, sell it. But we hope that you'll turn around and keep it, rent it out, and make money, cash flow as time goes by. That's when a conventional loan would be useful, right? You come back and we call it a takeout loan, where we take out that hard money, pay those guys off, we put you back into the more like 6.5 to 7, 8% range with a conventional loan, and then you hold on to it long term, rent it out, make that cash flow.
Now, in order for you to do that, you gotta have credit, you gotta have income, like you would if you're gonna buy it already turnkey. Right? Talk about that.
Yeah, that would be for a conventional turnkey conventional refinance. Now, there's other options there as well, but let's talk about conventional refinance first. Fannie Mae and Freddie Mac require a 12-month seasoning from the time you buy the property to the time you refinance the property for a cash out refinance. That means you're gonna get more money than what you put into the project. Okay? Now, there's no waiting period at all if you're just paying off the hard money loan.
There you go.
So be careful about how you set up your hard money loan, right? Take as much money as those guys will give you if you don't want to leave a bunch of money in the home.
Now, when he says that you can get more money than you actually put in, meaning if the lender gave you, let's say you put down 110 and they lend you the other 450. The property got appraised for a lot more than 450. You only can get 450 back to pay off the hard money lending.
That's correct.
Your 110,000, any other equity, it got to stay in because they just call that basically a refi, cash out. The hard money lending. You cannot get extra cash
Yeah, so if you're just paying off the hard money loan, we would call that a rate and term refinance, right? We're just paying off the existing loan on the property. Now let's use your example. Let's say the appraisal came in at $1 million.
That's right.
So you crushed it, right? You've got a great deal, great fix up. There's a pile of equity in there. Generally speaking, we would be able to do a 75% loan to value cash out refinance on that property.
But you gotta wait a year.
Now that's a $750,000 loan. You only paid $550 for the house.
That's right.
In order to get that extra money out, we've got to wait that 12 months.
That's right. For now.
For now.
Right? Yes. When do you think this new rule of waiting a year changed? Because back in the day, it was only 6 months.
That's right. It was 6 months. And if you're going to spend 110 in renovation, it's going to take you 4 or 5 months anyways, right?
Exactly.
So 6 months was never a big deal.
Right.
12 months is kind of a big deal now. I think that this is a tightening up due to market conditions where we saw prices come down last year. We saw some instability. I think we could see Fannie Mae and Freddie Mac change their guidance on this in the next year to 18 months. If we see a solidification of the housing market, we see things calm down.
Let's talk about the portfolio loan that you have for people who does want to keep their bird. They buy it, they rehab it, and they want to keep it, but their credit isn't great. They can't go to traditional. What other option they can have?
Sounds good. Yeah, so we have a couple of different portfolio products. One that we like the most is that we call it a DSCR or a DSCR. So DSCR just stands for Debt Service Coverage Ratio. And basically what that means is we underwrite the house by itself, right? So you have to have decent credit, but not perfect credit. You can do this with no job, no income, nothing. Now, they do want you to have already owned a home, right? So it's important that you own a home. This is not your first purchase. But if you've already got a house and you want to do this, then the DSCR program allows us to do a cash out refinance within 6 months, or at the 6 month mark, right? So it's between 6 months and a year, and you don't have to qualify for the property. The property has to qualify for the property. So most of these products require at least a 1-to-1 ratio. So that means if your mortgage is going to be $5,000 a month, your rents need to be $5,000 a month or better. And then you can do the refinance. So now that said, let's say that the payment was going to be $5,000 a month and the rents are $4,900. Doesn't mean we can't do it. We just have to lower the loan amount a little bit so that you fit under that guideline. So that's a really great solution if somebody's got a product that they've done a massive, awesome remodel on.
They've got a lot of equity, they don't want to sell it.
Ton of equity, they don't want to sell, but they'd like to pull that back out. That can happen in 6 months.
When you said earlier, you gotta have good credit. You don't have to be perfect. What does that look like?
They require a minimum 620 credit score for that program.
620? Yeah. So if someone were to buy a traditional home, first-time home buyer, right? It's 680, at least 680, right? Well,
so I can do as little as 580 on some of our government programs, FHA, VA. Conventional, you can see approvals at 620, but usually requires more down payment. For minimum down, like a 3 or 5% down, 680 is kind of the measure.
So many people have been talking about what they see down the road for interest rate. Based on your crystal ball and everything you've been hearing, right now we're August 2023. Where do you see interest rate in the next 12 months, 18 months, 24 months down the year?
Yeah, so I think that rates right now, and again, vanilla flavored, national average is around 7%, right? Plus or minus here or there. I think we're gonna continue in this market probably until about the first of the year. So January, February, March, we're gonna start to see things get significantly better as inflation comes down more and more. So then our gurus are predicting that we probably could see interest rates down about 1 full percentage point next year, and coming down as much as another full percentage point the next year. So if we're at 7 now, we could see 6s and low 6s by the end of the year, possibly into mid 5s and low 5s by the end of the following year. And that will be a spectacular opportunity for folks that buy today to be able to refinance then. Don't wait to buy then. Now, if you're 16 and you're not ready to buy, cool. But if you're ready to buy right now, you gotta get in while the getting's good, the prices are low, because what's gonna happen is when those rates go down, prices are gonna go up and it's not gonna be any more affordable then.
I've been telling people, man, I get hundreds of DM on my Instagram, you know, should I buy now, should I buy now? I've been telling you guys over and over and over, okay? Buy now, because when rates come down 1%, there's gonna be so many buyers coming on the field wanna buy, the price is gonna get basically multiple offer. If someone starts to buy a house and you pay 100 grand over asking price, 100 grand over asking price, the rates, 1%, 2% different, it's not even close to paying 100 grand over a sticker.
That's right.
It's crazy how much more.
Yep.
You know what I mean? What are they
Absolutely.
thinking?
Yeah, well, I mean, that's the thing. Like, generally speaking, a 1% higher interest rate is about a 10% increase in payment. So let's say it's $1 million house and your payment, you wanted a payment of $6,000 and it's gonna be $6,600.
$6,600.
Right?
Yep.
So that's $600 per month in extra interest you gotta pay over the next year.
Yes.
That's $7,200 for the year.
That's right, $7,200 a year.
But if you wait a year and you gotta pay $100 over sticker, you're trading $7,200 today for $100 grand tomorrow.
Even 50 grand.
Yeah.
It's stupid.
It's crazy.
You guys see what I'm saying? So what's the rule of thumb? When should someone refi? I hear the rule of thumb is it should be at least 1% and higher.
Yeah.
Tell them the rule of thumb on that.
That's a great question. That was the old school rule of thumb.
Okay.
And I would say that's reasonable.
Yep.
What I would say though is it really depends on your loan size, right? Because that rule of thumb is old and loan sizes used to be a lot smaller than they are today, right? Because a 1% difference on a $600,000 loan means a lot more than a 1% difference on a $200,000 loan, right? So my math is the break-even period, right?
Okay.
So general speaking, a refinance is probably going to cost you around $3,000 to $4,000. Okay. So if you could save $400 a month, and it costs you $4,000 to do it, you recoup your initial investment in 10 months.
Yep.
No brainer. Now, it might only be a 0.5% savings on a $1.5 million loan, right? So that rule of thumb of 1%, I think you got to throw it out the window now and pay more attention to the break-even period.
So if it costs somebody $4,000 to actually refinance a property, if it took them instead of 12 months versus 10 months, it's still worth it because they're breaking even in 1 year.
Still worth it, yes.
After the 1 year, then it's all positive from there.
Yeah, exactly, right?
Okay.
And so generally speaking, I would say anything that breaks even in less than 2 years is a great plan.
Oh, there you
Now,
go.
the other thing that we're planning on doing on this next round, because we always say that rates go up like a rocket and down like a parachute, right? They go up fast and they come down slow. So we offer a no-cost refinance as well. So that is where, now we're not paying for it, right? There's still a cost involved, but what we do is we take a little bit of margin from the interest rate and pay for it, okay? So what that might mean, let's say today's rate's 7%. Rates go down to 6%. And you say, well, hey, I really would like a 5% rate, but they're at 6 today. And I say, how about this? Instead of paying $4,000 to get 6%, let's get 6.25 and don't pay anything. So you give up a little bit of rate on the rate, so you don't save quite as much. But now guess what? The break-even period is day one. Because there's no cost. And now you've saved 0.75% on your mortgage. Then guess what happens? 6 months later, we see rates come down another 0.5%, 0.75%, we do it again. Right? So that's a way we ratchet down on what we're expecting to happen over the next few years. We can ratchet down. You never quite get the bottom, but you never pay for a refinance either.
This is why you guys love collaborating with this guy. You know, he owns a lot of property. How many rental property you own again? Tell me.
It's 22 units, 22 buildings, 128 doors.
So Cody, on top of being a good, educated, well-experienced loan officer, but because he also know about this, because he actually owns rental also. So if you guys are looking to buy property, refinance property, pull money, do a line of credit on your property, HELOC, but want to buy a rental property, figure out how to do the loan right for your specific needs and your wanting, your goal. This is why you gotta hit this man up right here, guys, because he has experience on doing loan, but more importantly, doing loan on investment because you actually live there also like me. Okay? So, you guys, if you guys like this video, okay, make sure you guys give it a thumbs up. If you have any question about how to buy your first property, buy a rental property, how to do loan, make sure you guys comment in the comment section so Cody and I can go read it, and then we can actually make some more videos for you guys, right? Maybe if you guys keep liking this, right, hit 40, 50,000 views like we did last time, we might do part 3 for you guys. Sounds good?
Sounds good.
All right, brother, thank you so much. Appreciate you. Talk to y'all soon. Peace.